With everything going on in the world, investing is more complex today than it's ever been. In this video, we're going to hear from two of the world's best investors, Ray Dalio and Raoul. They're going to share their thoughts on inflation and the markets today. Then I'm going to break down and analyze their thoughts while adding my own. Hi and welcome back. My name is Tom Heavey. I hope you're doing well. Let's get straight into it, and we're going to start with a very recent interview with Raoul.
I have been following something called the Chart of Truth, which is the long-term trend in 10-year bond yields. And it has a couple of times got to two standard deviations overbought. I don't know if Brian's showing the chart now, but two standard deviations overbought. But generally, it gets this kind of zone between 1 and 2 standard deviations overbought, and it reverses. So, okay, we should be on alert for something changing in bond yields. Why? Everyone's screaming inflation, but I think of the inflation at 8% as a massive tightening of monetary conditions, because neither corporations nor people can offset it with increase in earnings or price rises. So what you've got is a tightening of monetary conditions, particularly on lower and middle income households, because the earnings gap is massive between wage growth and the inflation numbers. And that tends to slow growth, and we're seeing forward-looking indicators suggest that growth is slowing down quite fast. And that will play out not immediately, but in the next 6 months. So I'm looking at this thinking, could everybody be kind of wrong at bonds? I mean, the last time it got to 2 standard deviations was when Jeff Gundlach was talking about yields going to 6%. They didn't. People are now talking about a structural shift in inflation. Is it possible? For sure. I still think the probability lies in the Chart of Truth. So then something else is going on in the bond market, which is the yield curve. Now, everyone's talked about this, but this is a really nice chart that shows the yield curve. Now, it goes up and down. It goes 300 basis points on the upside and maybe negative 50 on the downside. And usually when you get to negative, maybe a year later, you get a recession. So what's weird this time around, it's kind of peaked really early, which plays into the argument that I'm having that monetary conditions are actually, the inflation is actually essentially like rising interest rates 200 basis points already. So once the Fed start to rise, on the next chart, you can see what happens. So Brian, if you flip to the next chart, so these are the last 2 rate rises, and the yield curve is in orange. The yield curve flattens as soon as they start rising. So we're currently today 25 basis points from a yield curve going to 0. So I can't see how you can get interest rates to rise more than 50 or 75 basis points before you've actually created a recession. So that makes you think that if that's the case, that the forward-looking indicators suggest that there's going to be a potential recession ahead, then normally demand destruction comes. Along with the rise in prices causes demand destruction. The answer to higher prices is higher prices, is an old commodity market saying. So therefore, bond yield should come off, and particularly at the long end, because the long end is essentially the inflation element of it. So if we go to the next chart, here's the chart of TLT, which is the 20-year essential equivalent ETF. This looks like it's a big wedge pattern. It's right at the bottom of the range, and wedges like this, these triangle patterns, tend to lead to breakouts one way or the other. I think the balance of probability with a slowing economy, a risk-averse world, and inflation likely to peak over some point. I understand that the geopolitics has clouded that issue somewhat, that this looks like it's an interesting risk-reward when everybody in the world hates bonds. So that's something I've been focused on.
Okay, so Raoul raises a few interesting points here. His main focus is on the long-term trend in 10-year bond yields and the yield curve. Now, Raoul highlights that everyone is so fearful about inflation. However, his greater concern is the risk of a recession. Why? Because the forward-looking indicators are already suggesting the growth is slowing down quickly. Now, how does this tie into inflation? Well, in simple terms, inflation will normally rise in booming times, and it will normally fall in tough times as people spend less, and so prices naturally are not going to rise as quickly. If growth is going to slow in the future, this indicates that inflation, therefore, may fall, or structural inflation may fall at least. While there are supply chain issues, some individual items such as oil, they may remain high simply because of the limited supply globally. Now, as a result, Raoul believes the Fed don't have much wiggle room in terms of raising interest rates, nor do they have to raise rates as much as people are expecting. In fact, he states there is a significant risk of a recession if they raise interest rates by just 0.5% or 0.75%. As a result, while everyone in the world seems to be betting on higher inflation rates and hence rising interest rates, Raoul is taking the opposing view. He believes inflation could fall as growth slows, and therefore interest rates do not need to be raised by that much. In fact, there is a significant risk if they are raised too much because of a potential recession. Now, when it comes to investing, it's very important that we take a balanced view and hear perspectives from both sides. If we only listen to the camp screaming for higher inflation, we'll end up in an echo chamber. And of course, the same goes for those believing on the other side that inflation will fall too. That's why I want to share a clip with you from a very recent Ray Dalio interview. He talked about the long-term trend of America and how this links in with inflation. Let's give it a listen.
Now, let me, as I mentioned at the beginning, and as you pointed out in your slides, debt and the issue of the reserve currency are enormously important in your mind as you think about what it is you do every day in investing. I think for many people, the idea of federal debt or reserve currencies are very abstract things. Can you put them in? Can you clarify the importance of both? For the everyday listener, really.
Great. I'll try. I want to describe the mechanics, the cause-effect relationship of it. So one man's debts are another man's financial assets. And when there's more and more debt, that either has to be paid back in, let's call it hard money, which creates an economic downturn. Just by the nature of debt, when you borrow, you can spend more than you earn. But then when you pay back, you have to spend less than you earn if it was not deflated. So when you're holding it, like we're now in a cycle where most people think that the amount of money they have, it determines how rich they are, and they don't think of that in inflation-adjusted terms because they haven't had much of that. So think about it today. You get basically zero interest rate in an economy that has, last year was 7% inflation, but might have a 5% inflation. So when you think of cash, one thinks, oh, that's a safe investment. You don't realize that you're losing maybe 5% of your buying power every year, and that's not a safe investment, and that's not a good investment. So the mechanics of this, we're now in the part of the cycle where they, put out a lot of money. There's a lot of checks, and everybody gets a lot of money, and everybody's happy about that. But of course, as people spend the money, prices go up, and then people are surprised by inflation, and they have a higher level of inflation. So as that tilts, it changes the willingness to lend. And also in the world, because the world is owning so much dollar-denominated debt, because it is the world's reserve currency and they save in that, portfolios are heavily skewed to dollar-denominated debt. Now, if those didn't want, they're going to have to buy a lot more debt because we're still going to have a lot of deficits, and we're still going to have to sell that debt. And if they choose to sell that debt, and then you have to, not only the new deficits that has to be sold, but you have other debt that's sold, and that puts the central bank in the position of printing more money. So that's a very risky situation for both inflation and for the reserve currency status.
Okay, so in this clip, Dalio is referring to America's long-term trend. If you haven't been following his work over the past few years, I'd strongly recommend it. But I'll give you the oversimplified 30-second summary here. So essentially, if you look back through history, there have always been empires that rise and fall. The British, the Dutch, and many, many more. There are predictable patterns that precipitate this cycle, and America as a whole is demonstrating these patterns today. As an example, America has been spending far more than it earns over the past few decades. Now, just like any business or individual, this means America is racking up a huge debt. Now, while they have the world's reserve currency, this is not such a problem. However, they must implement steps to ensure that they reduce their debt and retain the dollar as the reserve currency, or the coming years may be more tough than those that preceded it. Now, don't worry, there are steps that America can take, but I'll leave that to Dalio to explain. There's an excellent video that he made that I will link in the description below. The point for us is that Dalio believes America is in a part of the cycle where they are forced to print lots of new money. As he says, if those around the world who own dollar-denominated debt decide to sell that debt, then the central bank has no choice but to print more money to absorb this effect. And obviously, if all else is equal, printing more money is obviously likely to lead to higher inflation. So, Dalio believes that in the long term, inflation is unlikely to fall based on where America sits today in their long-term trend. Raoul, on the other hand, he sees the situation today differently. Growth is already slowing, according to him, which means inflation should fall. Now, I know it's often confusing to hear opposing views on things, but I'm a big believer in presenting both sides of the argument, allowing you to come to your own conclusions. Like I say, while it's easy to get stuck in an echo chamber, just listening to one side repeating the same thing over and over, we learn much more by considering both sides. And it all goes back to a point that I will always highlight clearly. Diversification. If you want to protect against inflation, you can hold some gold or TIPS, Treasury inflation protected securities. If instead you believe inflation will calm down more quickly than most, you're probably bullish on the stock market. But the fact that the experts like this can't agree goes to show the value of hedging your bets and being well diversified across investments that both perform well in times of inflation and those which are more traditional holdings. So, who do you agree with? Raoul Pal or Ray Dalio? Let me know your thoughts in the comments below. Thank you for watching, and I will see you again very soon.